Hey everybody, it's Ed Conarchy back with Conarchys Corner. Hope everybody's doing well. Really quick Conarchys Corner here to bring you up to date on what's going on with mortgage interest rates. As I've been telling everybody for some time now that the mortgage-backed security market, guys, this is what mortgages are bought and sold for in the open market. I call it the stock market for mortgages. The buying and selling and the supply and demand of this market determine interest rates. We got whacked yesterday. I've been talking about this a little bit for some time now, that we believe that interest rates are heading higher. And one big reason is that next week, Wednesday, March 31st, the Federal Reserve stops subsidizing and keeping interest rates low that they've been doing for the last 15 months. We call it the training wheels. The training wheels are coming off and the market's going to have to step out on its own. And unfortunately, the support that the markets had to keep mortgage interest rates low is going away. And in fact, what the Fed is going to start to do is turn around and then start selling their mortgage positions, putting even more pressure on the interest rate market. So I'm here to tell you rates are going higher. I don't know the exact time that they're going to happen and how it's going to work. But yesterday, Wednesday, March 24th, was the first shoe to fall. We saw mortgage interest rates, gang, in 24 hours go up 0.25%. So where they were averaging, let's just call it round figures, 5%, they went to 5.25%. Now, it's amazing to understand the impact of just 0.25% on interest rate over a 30-year mortgage. 0.25% interest rate jump on a 30-year mortgage over that 30-year time frame on a $200,000 mortgage is $15,000. That's right. 0.25% jump on a $200,000 mortgage over 30 years is $15,000. So why I illustrate this is to let you know the importance of interest rates. It's not about just striking a deal with the seller on the sale of your home or trying to negotiate a short sale or a foreclosure purchase, that you need to be worrying about getting your deal and trying to get the lowest possible purchase price available on that property. You've got to worry about the other side of that teeter-totter, and that is mortgage interest rates. That mortgage interest rates have a greater impact on your monthly payment and the cost of that mortgage over 30 years than the actual sales price and the mortgage amount itself. So I'm here to warn everybody, you can't get cute with this, you can't play chicken with this, you can't hope that interest rates are going to stay low. That the market, not the Federal Reserve, and this is very important to understand, the Federal Reserve does not determine mortgage interest rates. They only determine monetary policy. What determines mortgage interest rates is the buying and selling, the supply and demand of that open market, the mortgage-backed security open market, as traders buy and sell. So as traders buy and sell, when fear creeps into the market like it did yesterday with the concern over sovereign debt from Portugal, and now the concern of US, British, France, and Germany debt, and the ratings, if those ratings fall, then what will happen is higher yields will be required to have people buy those debts. Higher yields mean higher interest rates for everything across the board. So I'm here to predict rates have seen their lows. They're going to go higher. The training wheels fall off next Wednesday, I should say, March 31st. So it's important to get in now. And the importance of saying, even in a pretty fair deal with a seller, buy your home now so you can lock in today, because waiting around, for example, on a short sale, it could take 4 to 7 months is the average that we've seen out there for a short sale to come together. Even if you got a deal on your short sale 4 to 7 months from now, if interest rates have increased a full point, that would mean $60,000 over 30 years on a $200,000 mortgage. So you've got to be careful here and not get focused on one thing. Remember, we call that compartmentalization, only to forget about the other very, very important vehicle here of mortgage interest rates. So make sure that we don't get focused on just one thing. We look at it holistically and the impact of interest rates to undo any good that you may have in your negotiating process. So keep in mind those important numbers. A quarter in rate jump on a $200,000 mortgage means $15,000. A 0.5% rate jump means $30,000. A full point rate jump on mortgages means $60,000 over 30 years on a $200,000 mortgage. And don't think it can't happen, gang. That if you flash back to last May of 2009, remember we experienced a 1% increase in mortgage interest rates in a 3-week period. So history's shown us it's going to happen, and I'm afraid it could happen again. So act now and don't delay. Don't regret not taking advantage of these low interest rates, and don't get trapped on just looking at sales price. Take that into account also with the mortgage interest rates. Hope that you enjoyed this week's Conarchys Corner. Have a great holiday. I'll be out, so there'll be no Conarchys Corner next week. I'll be out for spring break, and we'll follow up with you in 2 weeks. Have a happy Easter, happy Passover, and have a great spring break. Talk to you then.